We're focusing on the residential property market now, and we have had FNB's outlook on the remainder of the year for the sector, and it doesn't paint a cheery picture. We have FNB CEO of Home Loans Jan Kleynhas in studio, and also Herschel Jawitz from Jawitz Properties. And of course, my co-hosts Ashraf Mohammed and Simon Fillmore are still here. Thank you very much, gentlemen, for your time.
Thank you.
Now, when we say the picture isn't cheery, it isn't rosy, how bad is it, Jan?
Bronwyn, it's not bad, it's just not going anywhere with any dramatic speed. So we're seeing the market actually quite fragmented in the sense that the low end of the market, the so-called affordable housing, actually doing quite well from a capital growth perspective, all the way to the top end of the market, which is not really doing very well. So there's a lot of strain out there from a consumer perspective at the middle and upper income segments where the debt levels are stubbornly high. We're not seeing debt come down, which is what we were hoping for in the last couple of years. And then you've got cost increase in the form of utility costs going up, transport costs, and so on. So,
and of course, let's mention electricity, those utility costs coming through. Looking at the fact that we are at 30-year lows on interest rates, I mean, surely that should be where we see the property market sparking.
Theoretically, yes, and if you take into account that property prices are probably 15 to 20% off where they were at the peak, this is the time to buy property. But I think there are other factors at play. I think there's just a general cautiousness in the market now. I think buyers are sensing it's a buyer's market, they're shopping around. I think there's just a wariness about taking on debt as well. I think there are concerns about all of this issues around disposable income, electricity. I think there's just a general cautiousness, and so buyers aren't jumping in like they should. And I think, bank lending is an issue because I think that issues around deposits and interest rates are also to some degree hampering a real recovery in the market.
A quote that you had in some of your commentary earlier is that in the prior years we saw buying decisions made with a heart. Now buying decisions are being made on a calculator, or with a calculator rather.
I think there's a lot of uncertainty about what if people put money into their property, are they going to see it again anytime soon? And therefore their intentions or their aspirations of why they're going into property, I think, needs to be a lot clearer. In the past you had investment opportunities that were very evident. Now it's much more about, well, what are my motivations, or what am I going to achieve? Am I looking for income growth? Am I looking for capital growth? Or is this a pure residential investment that is for the family? So it's a lot more clearer.
Well, one of the factors I think that has probably added to the pressure is the requirement from the banks in terms of loan-to-value ratios. And I think that's probably sitting about 70% across the board at the moment. Do you see that going up any time over the medium term, which I think would facilitate growth in the residential property sector?
It's actually a little higher than that. It's probably more in the early 80s. What we're seeing, though, is that there's a lot better behavior from consumers when they put money in the game, skin in the game. Their propensity to repay is that much better. So from a lending perspective, we're saying we're far more sort of open to customers. Obviously, we're putting deposits down. Yes, they have to save more. Yes, it means that perhaps to Herschel's point that it's going to take time for people to come up with the money to put the deposit down. But it's a far better prospect for property in general, because otherwise, if there's too much lending at the 100% level, and then you get distress or you get an economic slowdown, then you have a plethora of properties hitting the market. So we think it's a healthier way to lend. Clearly, I'm being biased from that perspective, but I just think to achieve less volatility and more stability in the market, we think it's a better lending environment.
We'll get Jan. We'll let him get away with talking his book. Ashraf, you've got a question.
Just a question for Herschel. I mean, with these higher rates and electricity costs, are you seeing the property sizes, the smaller properties, turning over a lot quicker than the larger ones?
I think there is some part of it that you can ascribe to the pressures on disposable income, electricity costs. I think just generally lifestyle trends are dictating that as well. And I think the one encouraging part of the market that we're seeing is that, as Jan mentioned, certainly at the lower end of the market there is more activity. The underlying demand is still strong. Yes, there are challenges with finance and deposits and ability to lend, but there is underlying activity at the lower end of the market, at that sort of townhouse apartment segment of the market, and a lot of that is coming from first-time buyers. So, when the recovery comes, it seems to be a bottoms-up approach, and that's far more sustainable for the market.
And certainly high-density properties are very valuable at the moment, and developers have already cottoned on to that idea, haven't they?
Slowly. They're not
I
jumping
mean,
in with
they're
any-
not as fast off the
Absolutely.
starting block.
Absolutely. I mean, just talking about the density sort of, I guess, migration. We're just seeing people with bigger properties, more expensive properties, just saying, it's expensive to run these properties. If there's an opportunity to downscale, just from a pure cost perspective, they will. So you're seeing a much more greater migration to a smaller property, whether it's a lifestyle change or whether it's a downscaling due to financial pressure. There's definitely that trend.
You wanted to ask a further question there, Simon.
Yeah, I guess one theory that was put forward to me quite recently is that we'll probably see another property boom in the next 3 to 5 years. And one of the reasons is that obviously property prices, the price of them is going to be dictated by the supply and demand equation. And in terms of service delivery, getting services to new property developments, electricity from Eskom, all of those seem to be quite problematic at the moment, and the amount of housing stock that's going to come into the market is set to decline quite considerably by some accounts.
I wouldn't be quick to talk about a boom. I'd rather talk about a gradual increase. But our view is that this could be a 5-year process, and it might be not doom and gloom. But I think this market is going sideways. It has for a number of years already. And there's pockets of activity. Your metropolitan areas are actually doing pretty well. But the minute you move out the metropoles, certainly into coastal, it's tough. It really is tough out there. So it's a very sort of patchy market, and therefore we're not seeing, and because of an excess in supply, quite frankly.
Well, some interest being sparked by our viewers this evening, and Joe from Santon saying with household debt so high and banks not lending, he says banks aren't lending, who is actually buying property? So perhaps let's get a view from each of you on this. Jan, starting with you.
People that are buying property are those that can afford it. It's as simple as that. So when we're saying we're not lending, relative to what? Relative to 5 years ago, I would agree with that. Perhaps the lending in 5 years ago was not the most healthiest sort of lending in any case. So I think there's a far more mature sort of borrower right now. There's a lot more cognizance taken from us as a bank about sustainability, the future prospects of people able to repay their debts. And so we've been through a terrible time in terms of distressed selling of properties and so on. And we don't want to repeat that. It wasn't good for the market. It wasn't good for the consumer. So we're in the space now where we'd rather lend appropriately, take some risk around people that are highly qualified, that have a high income trajectory, not necessarily having experience around servicing debt. But that's really the picture from our perspective.
And who do you see buying property in this current environment, Herschel?
Yeah, so I mean, the picture isn't all doom and gloom. So as Jan said, I mean, the metro areas are pretty busy. You look at areas like Durban, Johannesburg, Cape Town, they're pretty busy. The leisure coastal areas, very, very soft market. And I think there are always people in the market. So especially at the low end, your first-time buyers, or people looking to get into homes at 300,000-400,000, people who are expanding families, just got married, suddenly got a bonus, an increase. So there are always people that are looking to buy. I think what's interesting, as I said earlier, is that we're seeing much better demand at the lower, middle, upper than the luxury end. And so the luxury end, I think to some degree, is being hampered by issues like consumer confidence. I'm in a beautiful home. I'm in a home worth 3 to 4 million rand. I don't really feel like or need to upgrade. And in the current environment, I'm not going to. It's very different with people who've suddenly got an increase, time to buy, got a bigger family, need to buy, and they're making buying decisions. There are less of them, but there are buyers out there.
And what's happening to the black diamonds? Finweek is running an article at the moment in the 7th of July edition saying that the black diamonds are nowhere to be found at the moment. In 2007, you saw them wanting to get into the housing environment, buying property at any price, and now they are absent. Is that a true reflection of what's happening out there?
I think there was so much buying done, Bronwyn, in the earlier years of 06 to 08, 2006, 2008, that a lot of the buying, I think, from perhaps that segment has happened. The growth thereafter, I think, is a sort of right across the board, across the racial spectrum, if you like. And I think, the so-called black diamonds, we're very sort of savvy about the investments. They bought at the right time. They're far more stable in terms of where they want to be. I think, talking to Herschel's point, there's no real point to go anywhere else. They're not going to perhaps get their money back quick, and therefore they'll stay where they are as long as they can afford what they're in.
But even as a percentage of the buyers in the boom, it was still a relatively small percentage of the boom market. I think a lot of the black diamonds were perhaps looking at smart cars, cell phones, lots of quicker, easy, disposable, consumer orientated than property. And so the fall off hasn't been that that pronounced as with other sectors of the buying.
So perhaps journalists got carried away with headlines in terms of the impact that the so-called black diamonds were having in the property market at that time. Someone you wanted to jump in?
Yeah, I remember a couple of years ago, probably about 2 years ago, one of the CEOs from one of the banks was saying that they were a little bit worried that instead of bonuses, they'd have to give away houses and cars because the amount of repossessions that were going on at that stage. Can you give an indication of the levels of repossessions at this stage of the cycle?
I can talk from our perspective, where we've been quite clear, I think, on the prospects of people able to recover. You know, there was a huge amount of job loss, there was income loss and so on. And consumers that were caught up in that and in fact took on a lot of other debt, we just got to realization that unfortunately those consumers weren't going to make it, and therefore we've introduced a program called Quick Sell, which was really about helping people dispose of property in the most elegant way without taking too much loss. So we, as a bank, FNB has moved quite quickly to do that. Across the sector, I think different banks have had different responses to that situation. Some banks have helped consumers more with repayment options and so on. I think it's stabilized. I think it's settled down. There's still a lot of stress out there. We're very concerned about the extent of unsecured lending into the residential lender, if you like, where they take on more and more debt. And I think what's happening, they're just borrowing and getting to the point where they can't get more credit, and therefore it forces a default situation. It's compared to 2 years ago, it's a lot better, but there's still concern about the level of debt out there.
Ashraf, can I ask you a question? Because last night we were speaking to Gina Skuman, who came out with Absa Capital's quarterly briefing on the economic front. And there was the stipulation that this has been, to this point, a consumer-led recovery, and that there isn't a safety net for the consumer at the moment. And I think we've got to shift this conversation now to what happens when we start seeing interest rates rising. It's not about when we see that first interest rate hike. It's about how quickly are they going to go up, and how high are they going to go. Does that seem funny?
You hijacked part of my question for Jan.
We're on the same page. I think we sit on the news desk too often together.
Yeah. Our view in-house is that you're not going to see an interest rate increase until second quarter next year. A lot of people are saying, by the earliest at the beginning of the fourth quarter. Our view is that, yes, inflation will pick up because you'll see base effects coming through, and you'll see inflation at 5.2%, 5.5% when you're looking at September, October, but then it will start tapering off. But that's not going to be indicative of consumers willing to pay higher prices. The price increases are, it's really a cost push inflation rather than demand pull. And our view is the consumer will remain under pressure. When you look at countries such as the UK, where they've really implemented austerity, consumers are on their knees. And a few of my friends' wives are shopping in London at the moment because everyone is discounting their products by 50 to 60%. And the rand is a lot stronger. And you're seeing that. You'll see that happen across Europe. So demand coming for products in markets we've traded with, historically, being big trading partners, not going to look good. So I think employment is going to be slow on the rise. Therefore, if they raise rates, they're really going to kill the consumer.
Now, we still have a caller on the line. Joe, we have already addressed your initial question, that being at the moment who is buying property with the banks, as you say. Well, you have phrased it that the banks aren't lending. Jan did address that question. Do you have anything further to say or to add to that initial line of questioning, Joe?
No, what I'd like to know is, we all know that even in America, the housing market is in a double dip, and that's actually affecting the overall economic growth of the country. Now, with South Africa and the mines and the strikes and the 15% wages and our outputs, which are very low, how can we say that there's actually a recovery when mining is one of the cores of this country?
Well, I'm going to put that to my market commentators. I think, Simon, are you going to try and field that?
Yeah, I think, obviously there is a base effect from earnings being particularly low over the last 2 or 3 years. So compared to 2 years ago, certainly earnings are a lot stronger, and a year ago as well. And I think because we are a commodity-based economy, we obviously feed into what's happening in China and India. They're continuing at high single-digit growth rates, and that's obviously been very good for our commodity companies. Anglo's Bulletin, we're going to see 40 to 50% earnings growth for those companies this year, and that profitability will feed down through the ranks.
Ashraf tabled his view on interest rates and where they're going in the foreseeable future. Jan, it would be interesting to get your view on this.
It's a tough one, and I agree. The demand, consumer demand, isn't really there. So, a environment driven by spending and credit growth, I don't think will necessarily be the cause of interest rate increases. It's probably going to be a cost push scenario. Our concern would be that if rates go up, if we have a shock to the system and rates go up more than 2%, it's going to be tough. So the ability for consumer to withstand 1 or 2% is, the jury's out. The problem being that the debt levels are stubbornly high, costs are high, so there's not a lot of space for consumers to hide when it comes to interest rate increases right now.
This must be a stress factor for you as well, local interest rates and how high they are going to go and how quickly.
Yeah, listen, we're definitely seeing that buyers are cautious, and when we talk to buyers about affordability issues, what they're prepared to pay, most of the buyers we're talking to are factoring in some interest rate increase, and they're saying, listen, we can't go beyond this level because we're taking into account interest rates going up into 2012. So I think buyers are very aware. I'm not so sure it's going to hamper demand, because demand is relatively soft at the moment. I think where the residential market might take strain is, as Jan mentioned, those buyers, or those homeowners rather, who spent the last year and a half clawing their way back into some sort of position where they've caught up some of their debt. And I think for those homeowners, that could be the killer blow, and that could send more distressed property, more repossessed property back onto the market.